Welcome to Reading Financial Statements, the Key to Value Investing. Did you know that over 60% of individual investors never look at financial statements? That's a shocking number. It means most people are missing out on critical insights that could boost their investment returns. Here's a surprising fact. In 2020, only 25 companies in the S&P 500 had a return on invested capital, ROIC, above 20%. These companies know how to make their money work hard. Understanding financial statements can help you spot these high performers. In this video, we'll unlock the secrets of financial statements. We'll dive deep into balance sheets and income statements. You'll learn how to decode cash flow statements and use key financial ratios. We'll also show you how to spot red flags in financial reports and future-proof your investments. By the end of this video, you'll have the tools to read financial statements like a pro. You'll be able to find hidden gems in the stock market and avoid potential traps. Are you ready to take your investing to the next level? Let's get started and uncover the power of financial statements together. Chapter 1. Unlocking the secrets. Understanding balance sheets. Understanding balance sheets is the first step to mastering value investing. A balance sheet is like a snapshot of a company's financial health. It lists what the company owns, assets, and what it owes, liabilities. First, let's talk about assets. Assets are divided into current and non-current. Current assets, like cash and inventory, can be turned into cash within a year. Non-current assets, like property and equipment, are long-term investments. Here's a tip. Always look at a company's liquidity. Liquidity means how easily assets can be converted into cash. The current ratio, which is current assets divided by current liabilities, is a good indicator. A ratio above 1 is a good sign. Liabilities, on the other hand, show what the company owes. Current liabilities are due within a year, while long-term liabilities are due after a year. Keep an eye on the debt-to-equity ratio. This ratio helps you see how much debt the company is using to finance its assets. A high ratio might mean higher risk. Next, let's discuss shareholders' equity. This is what's left after liabilities are subtracted from assets. It represents the net value of the company. Positive equity means the company has more assets than liabilities, which is a good sign. Have you heard of Warren Buffett's approach? He looks for companies with a lot of retained earnings. Retained earnings are profits that a company reinvests in itself, rather than paying out as dividends. This shows that the company is focused on growth. A unique fact: Apple Inc. had over $100 billion in retained earnings in 2020. This shows its strong focus on reinvestment and growth. Another tip is to look at the book value per share. This is shareholders' equity divided by the number of outstanding shares. It shows the value of the company if it were liquidated today. A stock trading below its book value might be undervalued. Chapter 2. Profit or peril? Decoding income statements. Income statements tell the story of a company's profitability over a period of time. They include revenue, expenses, and net income. Let's break down each component. Revenue, or sales, is the total amount of money a company makes from its products or services. It's the top line of the income statement. Look for consistent revenue growth. This indicates that the company is expanding its market share. Did you know? Amazon's revenue grew from $107 billion in 2015 to $469 billion in 2021. This explosive growth shows its dominance in the market. Expenses are the costs a company incurs to generate revenue. They include cost of goods sold, COGS, operating expenses, and interest expenses. Lower expenses relative to revenue mean higher profitability. A key metric to watch is the gross margin. This is revenue minus COGS, divided by revenue. It shows how efficiently a company produces its goods. A higher gross margin means better efficiency. Operating income, or EBIT, earnings before interest and taxes, is another important figure. It shows the company's profitability from regular operations, excluding financing and tax costs. This helps you understand the core business performance. Net income, or the bottom line, is what's left after all expenses are subtracted from revenue. Consistent net income growth is a positive sign. It shows that the company is not only growing its sales but also managing its costs well. Here's a unique fact. In 2020, Tesla reported its first annual net income after years of losses. This was a major milestone, showing that its business model is finally paying off. Keep an eye on earnings per share, EPS. This is net income divided by the number of outstanding shares. It's a key indicator of a company's profitability on a per-share basis. A growing EPS is a positive sign for investors. Another strategy is to compare the company's performance with its peers. Look at industry benchmarks to see if the company is outperforming its competitors. This can give you a better sense of its market position. Chapter 3. Cash is King. Mastering cash flow statements. Understanding cash flow statements is crucial because cash flow can make or break a business. While profit is important, cash flow is what keeps the company running day to day. First, let's look at operating cash flow. This shows the cash generated from the company's core business operations. It's a great indicator of whether a company can sustain itself through its regular business activities. High and consistent operating cash flow is a good sign. A fun fact: in 2020, Microsoft reported an operating cash flow of $76.7 billion. This shows its strong ability to generate cash from its operations. Next, there's investing cash flow. This includes cash used for investing in assets like property, plant, and equipment, or buying other businesses. Negative investing cash flow can be good if it's due to the company investing in its growth. For instance, Amazon often has negative investing cash flow because it continuously invests in new warehouses and technology. Financing cash flow is the cash moving between the company and its owners or creditors. This includes dividends paid, cash from issuing or repurchasing stocks, and cash from issuing or repaying debt. It helps you see how a company finances its operations and growth. Did you know? In 2021, Apple returned $28 billion to shareholders through dividends and stock buybacks, indicating its strong cash position. A key strategy is to compare the operating cash flow to net income. This ratio, known as cash flow to net income, should ideally be above 1. It indicates that the company's earnings are backed by actual cash. Look out for companies with positive free cash flow. Free cash flow is the cash a company generates after accounting for capital expenditures. It's crucial because it shows how much cash is available to return to shareholders or invest in growth. For example, in 2020, Google reported a free cash flow of $42.8 billion, highlighting its strong cash-generating ability. Another tip is to watch for changes in working capital. Working capital is current assets minus current liabilities. Significant changes can indicate issues with cash management or changes in business operations. A unique fact: Warren Buffett once said, "Cash is to a business as oxygen is to an individual." Never thought about when it is present, the only thing in mind when it is absent. Chapter 4. Ratios that reveal key financial metrics. Financial ratios are powerful tools for evaluating a company's performance. They help you compare different companies, even if they're in different industries. One important ratio is the return on invested capital, ROIC. It measures how well a company generates profits from its capital. A higher ROIC indicates a more efficient company. Look for companies with a consistent ROIC above 10%. A fascinating fact: between 2010 and 2020, Apple consistently had an ROIC above 20%, showcasing its efficient use of capital. Next, consider the free cash flow yield. This ratio compares the free cash flow to the company's market value. It helps you see if the company is generating enough cash relative to its price. A higher yield can indicate a potentially undervalued stock. For instance, in 2020, Intel had a free cash flow yield of around 7%, making it an attractive option for value investors. Another key ratio is the debt-to-equity ratio. This measures a company's financial leverage by comparing its total liabilities to shareholders' equity. A lower ratio is generally better, indicating less reliance on debt for financing. Did you know? Coca-Cola had a debt-to-equity ratio of 1.84 in 2020, showing its moderate reliance on debt. The price-to-earnings (P/E) ratio is also vital. It compares the company's stock price to its earnings per share. A lower P/E ratio might indicate that the stock is undervalued, especially when compared to industry peers. Benjamin Graham, the father of value investing, often looked for stocks with a P/E ratio below 15. The current ratio is another useful metric. It measures a company's ability to pay its short-term obligations with its short-term assets. A current ratio above 1 indicates good liquidity. For example, Johnson & Johnson had a current ratio of 1.36 in 2020, reflecting its strong liquidity position. The dividend yield is important for income-focused investors. It shows how much a company pays out in dividends relative to its stock price. A higher yield can be attractive, but make sure the dividends are sustainable. In 2020, AT&T had a dividend yield of over 7%, appealing to dividend-seeking investors. Lastly, look at the gross profit margin. This ratio compares gross profit to revenue, showing how efficiently a company is producing its goods. A higher margin indicates better efficiency. A unique fact: in 2020, Procter & Gamble had a gross profit margin of around 50%, showcasing its efficient operations. Chapter 5. Earnings Quality. Spotting red flags in financial reports. Earnings quality is about how reliable and sustainable a company's earnings are. High-quality earnings are consistent and repeatable, not one-time windfalls. Let's dive into how to assess earnings quality. First, check for aggressive revenue recognition. Companies sometimes record revenue before it's actually earned to boost their numbers. Always read the notes in the financial statements to understand the revenue recognition policies. For instance, Enron recognized revenue from long-term contracts immediately, which was a red flag that eventually led to its collapse. Next, look for unusual expense patterns. A sudden drop in expenses might be a sign that the company is cutting corners or delaying payments to make the financials look better. Consistent expense management is a positive indicator. Another red flag is off-balance sheet financing. This means the company has liabilities that aren't listed on the balance sheet. Always read the footnotes for any mention of off-balance sheet items like operating leases or special-purpose entities. Did you know? Lehman Brothers used off-balance sheet financing extensively before its collapse in 2008, hiding billions in liabilities. Check for one-time items or extraordinary expenses. These can distort the true picture of a company's profitability. Adjust for these items to get a clearer view of the company's ongoing performance. Here's a tip. Compare the net income with cash flow from operations. If net income is consistently higher than cash flow, it might indicate earnings manipulation. High-quality earnings are backed by strong cash flow. A unique fact: Warren Buffett values consistent, predictable earnings. He famously said, "We like things that you don't have to carry out to 3 decimal places." Review the auditor's report. If there are any qualifications or concerns raised by the auditors, take them seriously. It can be an early warning sign of deeper issues. A high-quality earnings indicator is sustainable gross margins. Look for companies with stable or improving gross margins over time. This shows they can maintain profitability even as they grow. Consider the company's competitive advantage or moat. Companies with strong moats tend to have higher earnings quality because they can sustain profits over the long term. Look for unique products, strong brand loyalty, or network effects. For example, Coca-Cola's brand loyalty and extensive distribution network give it a durable competitive advantage. Lastly, look at management's track record. Consistent leadership and strategic vision are often reflected in high-quality earnings. Frequent management changes can be a red flag. Understanding earnings quality helps you spot reliable investment opportunities and avoid potential pitfalls. By focusing on revenue recognition, expense patterns, and cash flow, you can assess the true health of a company's earnings. Chapter 6. Future-proofing investments. Analyzing trends and forecasts. Analyzing trends and forecasts is key to future-proofing your investments. It's not just about the past but also about where the company is headed. First, understand industry trends. Look at the overall industry growth and the company's position within it. A company in a growing industry with a strong market position is likely to perform well. For example, the electric vehicle industry is growing rapidly. Tesla's strong position in this industry suggests significant future potential. Next, consider the company's growth strategies. Are they expanding into new markets or developing new products? Growth strategies should be clear and realistic. Look at past performance to gauge the likelihood of future success. Did you know? Amazon's expansion into cloud computing with AWS has been a major growth driver, significantly boosting its revenue and profitability. Check the company's capital expenditure plans. High capital expenditures can indicate growth, but make sure they're investing in the right areas. Look at the return on these investments. Another tip is to analyze earnings forecasts. Analysts' predictions can give you an idea of future performance. However, don't rely solely on these forecasts. Use them as one of many tools in your analysis. Look at the company's innovation pipeline. Companies that continually innovate are more likely to stay ahead of the competition. Check for patents, new product launches, and R&D spending. A unique fact: Apple invests heavily in R&D, spending over $18 billion in 2020. This focus on innovation helps it stay at the forefront of technology. Consider macroeconomic factors. Interest rates, inflation, and economic growth can impact a company's performance. Understanding these factors helps you anticipate potential challenges and opportunities. Review the company's strategic vision. Management's long-term vision should align with market trends. Listen to earnings calls and read annual reports to get insights into their plans. For instance, Microsoft's shift to cloud computing and subscription-based services reflects a strategic vision aligned with market trends.